Benjamin Swinburne spent several years at Lucent Technologies before joining Morgan Stanley in 2007. That telecommunications industry experience affords him a level of understanding that few analysts can match. This year he claims his first appearance in the winner's circle for coverage of cable and satellite companies, and also captures second place in the media sector.
Working in the telecom industry was a great place to start and launch myself into sell-side research. The company was in essence a technology company, but my role was in the M&A and audit area, and bringing together technology and finance for a couple of years before coming to Wall Street really served me well. A virtual cable operator is effectively a technology company that's taking advantage of the connected home and broadband delivery of video to compete head-on with the cable, satellite, and telecom companies in pay TV. It's a $100 billion a year market. I think it's likely you see some new entrants in that space. And to put it into context, if you think about the last 30 years, you had a monopoly cable business that then faced satellite competition in the mid-90s from DirecTV and Dish. Then AT&T and Verizon entered the market in about half the country about 10 years ago. And at each level, that incremental competition has changed the landscape dramatically in this business. When you think about the idea of a Google or an Apple or an Intel coming in and representing not just new competition, but well-capitalized, sort of consumer-savvy, technology-driven companies, the possibilities and the impact on the space are going to be significant. Well, I think for the cable satellite group for the rest of 2013, the first thing people are really focused on, as well as us, is consolidation. It's an industry under a lot of pressure with rising programming costs. It's a mature industry. And typically, particularly in a low interest rate environment, you tend to see an increase in M&A. There's been a lot of speculation this year. We haven't seen it yet. But I think that's going to be a big dominant theme through the rest of this year. On top of that, I think you'd have to add how the technology companies attack this market. There's been a lot of speculation about Intel and Sony in particular, signing up linear networks like Viacom's and Disney's to deliver over the web. We'll see if it actually happens, but if it does, it's a real game changer for the space. Historically, there has been a relationship between interest rate, leverage appetite in the market, and stock performance in this group. This is a very levered sector from a financial perspective. So any material change in the debt markets, I think, has an outsized impact on these stocks. So if financing becomes much more difficult, like we saw 4 or 5 years ago, that's something that really you have to take into account when you think about this sector, because it eliminates a lot of the share repurchase activity that are driving these stocks, and probably removes a lot of the M&A potential in the group, at least temporarily. So interest rates and the capital markets are probably one of the main things that could change our view looking out through the rest of this year.